Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. Coming out of a long weekend, Tuesday morning, and it's still all about Trump, what he says, what he does, etc., etc. Markets, though, looking much better. We're coming to you from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. With me, my colleagues Nigel and Surabhi. Guys, good morning.
Hi, morning. Good morning, folks. And I guess this weekend was a much-needed relief and respite to disconnect from the maddening news flow, right? But of course, we're still following most of it. There was plenty of it. And I think the question that we'll be asking a lot of market participants today is whether the worst from a market perspective is over.
Well, it'll be difficult to answer that, right? Because you don't know what President Trump is going to do next. But at least some kind of a solution with regard to maybe a couple of countries, US and Japan, I think that holds the key. And that will give us a broad, trajectory in terms of how global equities could behave as well. Because Japan has the highest amount of debt, invested in the United States. So we'll have to keep an eye on that.
Absolutely. But 2 days worth of Wall Street action to react to. And,
that made for intense reading last night.
All right. Well, let's just take it from the top then in terms of the, the changes, really. So this is the last 2 days, basically Friday and then Monday, the sessions that we have to react to, the cumulative net change. The S&P 2.6 higher, the Nasdaq 2.7 up. You have the CBOE Wix, which has fallen 26%. I saw a comment from Treasury Secretary Besant this morning as I was walking in, saying that probably we've seen the peak volatility. And maybe that is right. I mean, just in terms of sheer gap up and gap down. I was saying this on Friday on Editors Roundtable. We did not know what markets will do Friday evening. But the average sort of range for the S&P 500 for the first 4 days of last week, Monday to Thursday, was 7.8%. Almost 8% range. I mean, this is just incredible. The macro markets now, the 10-year yield, 6 basis points lower. We saw a pretty large move last night, so that kind of netted out. -6. Dollar index about 0.85 lower. We are under 100 levels on the dollar index. Oil prices are up about 2.5% over the last 2 trading sessions. So, I mean, this is a very nice and comforting screen. It's all relative. What we had was an absolute sort of horror show over the last 6-7 days, especially if you were a trader. And what we have as we come back this week into this, once again, a holiday shortened week, because Friday, once again, is a market holiday, is a much more comforting screen. Now, I'll just start with some of the news flow, which I think are important to take note of. There are reports which say that India and US officials have begun sector-specific trade talks virtually, and they will sort of really get into the thick of it. Maybe there will be in-person meetings as well. Japan-US meeting is this week. This may be the first country to get a deal. It's widely expected that they may be the first country because they reached out first. And of course, I mean, they've been very conciliatory, etc. And I think the reason why it's important is to track this is because this will give you a template of what they're ready to do, what they're not ready to do. And I think this may be, at least the markets may jump on it with some vigor depending on what gets done. Now, Trump said, and this is, of course, whiplash over the last 2-3 days now. First, of course, I mean, there was that notice from the U.S. Customs and Border Agency, which essentially put a pause on the tariffs on electronics, smartphones, computers, etc. Then Trump came out and said that the pause was temporary because sectoral tariffs were coming, because they've moved into another tariff bucket, apparently. So, again, there was reprieve, but there was this caveat as well that the reprieve is only because there are specific tariffs which are coming. Last night, Trump suggested relief for U.S. auto companies, but reiterated that pharma tariffs were coming. So, this is a little bit of this, a little bit of that. But one thing is clear, they're very set on sectoral tariffs from here. I mean, some of these, of course, they've labeled under national security considerations, but sectoral tariffs are very much coming. In what shape, form, size, we will know. The big question for markets is this. The reversal that we've seen, is this a full reversal? I mean, first of all, full reversal in policy. When I say reversal, I mean those, 100, 70%, 76% kind of tariffs across countries. They've kind of gone back. Now you're starting with a baseline of 10% tariffs across the board, and then you perhaps will look to put on tariffs on top of that. It's really tough to gauge policy direction, of course, because of what is being said. In a way, this is a situation where it is much better to follow what is done rather than what is said. And I think we really need to pay attention to what finally happens, because a lot what was said will happen has been reversed already. So in that sense, it's very difficult to go on the basis of what is being said now. What is clear is that markets seem to have found a point of reflexivity, which is nothing but basically we know where the put is. We were all talking about where is the Trump put. Maybe the Trump put does not exist for equity markets, but it certainly exists for bond markets, which is what has essentially forced Trump and the Trump administration to pull back from the brink. So we know that markets and market reactions matter. So there will be that reflexive kind of action which starts to come in terms of pulling back from the brink, like what we saw last week. The Fed also had a few things to say. So the Fed, Collins said that the Fed is absolutely ready to help stabilize the market. This was, I think, on Friday. Then Waller last night said that the risk of recession could outweigh the risk of escalating inflation. This was read at the margin as being slightly dovish. Market implied odds for a recession are still around the 50% mark. So it's like a coin toss. So really difficult to kind of plan for anything in an environment like this. And we will, of course, have to track this hour by hour because commentary seems to be that way. Now, I'll just having said all of this, we are, of course, in a much better place now as compared to what we had, where we were, last Tuesday, Wednesday, etc. I mean, things may change still yet, but the point is we may, at least in terms of sheer volatility for now, have seen the worst of it. Now, just some levels here. Nifty last Friday broke above the previous high of 22,697 and 22,806. 22,806 is the 50% retracement of the previous fall. The next target is 23,057, which is the 61.8% retracement of the fall. So that's the next immediate resistance which comes in. Nifty Bank has got major resistance between 51,307 and 51,360. We made a high of 51,244 and then have seen some selling pressure. So this naturally becomes a resistance to beat. And on the way down for the Bank Nifty, the support comes in at the 20-day moving average, which stands at 50,434, and the 40-day exponential moving average, which is 50,079. The GIFT Nifty will come up on your screen. And of course, it's indicating a gap up as opposed to where we left off on Friday. You are reacting to much better screens, much better markets around the globe. Surabhi.
Absolutely. And even I saw that Christopher Waller comment, Prashant, and it's quite interesting. He's saying that the effects of inflationary effects of these tariffs, they'll be transitory, and that was widely picked up by the press. Yeah. So he seemed to be striking a very dovish tone. Just to go back on the commentary that President Trump has been sort of giving out to the market since last night. So we picked up the more operative parts of that big, long social media post that he put up. And this is after what some people called was a bit of a rollback on electronics and semiconductors. He says nobody is getting off the hook. And he goes on to say, especially not China, and which by far treats us the worst. So the commentary and the language is also very hawkish, at least in the social media posts. And he said that there's no tariff exception announced on Friday. These products are subject to the existing 20% fentanyl tariffs. They're just moving to a different bucket. Then he says that we're taking a look at semiconductors and the whole electronic supply chain in the upcoming national security tariff investigation, giving a sense that there could be more coming on electronics and on semiconductors. So then he again reiterates, we need to make products in the United States. We will not be held hostage by other countries, especially hostile trading nations like China, which will do everything within its powers to disrespect the American people, etc., etc. So the tonality of this message that was put up did not seem very dovish or very reconciliatory. But let's see what eventually comes. For now, it seems that there's a bit of a tariff reprieve on semiconductors and on certain electronics as well. By the way, on autos, again, his quote was, I'm looking at something to help some of the car companies that need a little bit of time because they're going to make parts here, which is giving some hope and expectations for the auto space. Auto stocks, by the way, last night in the US were up. Ford, GM, etc. All those shares were up 2-3%. But as a lot of this rolls on, let's not forget that there is legal action as well. There is another suit now that's been filed. This one is in the US Court of International Trade against tariffs. And the people who filed, a bunch of businessmen who filed this lawsuit What they're saying in this suit is that tariffs have been imposed illegally, and the trade deficits, which have been on with several countries for many decades, they don't justify necessarily an economic emergency. So all of this is ad hoc, arbitrary, and illegal. Let's see where the suit goes. For the time being, Asian markets are only building onto gains. Monday was a very good day in Asia as well. Most markets were up between 0.75% to almost 2%. And this morning, we're seeing more of the same. The Hong Kong market is actually the one that's a little quiet. But if you're looking at the Japanese markets, if you're looking at some of the other regional indices, Singapore, etc., they're still up and about. Hong Kong and Shanghai, these are two markets which have broken away from this rising tide, so to speak. By the way, in South Korea, there's already an announcement for semiconductors. The government there has announced a $23 billion package to support the semiconductor industry. In currencies, Friday saw big peaks, massive peaks on the yen as well as the euro because of the risk aversion trade. Now, over the course of yesterday, last night and this morning, these currencies have cooled off a little bit. The dollar is trying to find some ground. The peak on Friday for the euro was 1.14, and the peak for the yen was 142.05, and these were the high levels. From there, these currencies are slightly lower. Now, on the point of this all-important meeting, the Japan-US meeting, just a couple of things. The Japanese Prime Minister yesterday actually struck a bit of a mixed note. He said that there are no plans, Japan has no plans to make big concessions, and we're not in a rush to make a deal this week itself. And why do I talk about this week? Because the Economic Revitalization Minister of Japan, he's traveling to the US and he's likely to meet Scott Bessent as well as USTR Jameson Greer as early as Wednesday. So let's see if we get a deal out for Japan or not. And finally, on the oil markets, by the way, OPEC has cut its forecast for 2025 and 26 by several million barrels. So let's see how oil prices do. Goldman Sachs came out with very sobering targets on oil as well. Now, where does this leave us? I was mapping the recovery from the lows, the lowest point of this tariff fall for markets around the world. And actually, we've not recovered at all. I mean, the other markets have recovered, big time. 8 to 9% recovery, almost 75% of the fall has been recovered by the US indices in the last couple of days. We were shut for a couple of trading sessions, so we're behind the curve. India is up only 3% from the April low. So will we play catch up? Will the bulls really charge on the street? The only caveat to that is that the charging bulls still have to deal with negative FII flows. The selling on Friday was about 2,500 crores. Domestic institutions or buyers, so that was a big help. They bought almost 3,800 crores in terms of cash markets. So let's see the flows picture. And finally, results season is also beyond all the tariff headlines. Results season is in full bloom. Today, we'll hear from companies like ICICI Lombard, ICICI Pru, as well as IRDA. So plenty to keep us busy today, Nigel.
Well, that's right. Let's start off, though, with the troika. Brent crude prices are well behaved despite those cuts of forecast overnight. And Brent crude prices being stable, not falling off the cliff, that is not such a bad thing, actually. From an Indian market perspective, it's good. But from a global perspective, if Brent crude prices slides more, that's indicating a big recession globally as well. So it's holding around the $65 per barrel. The dollar index at a 3-year low, so that's good news, sub the $100, the 100 mark, which is good news from an Indian market perspective, an emerging market perspective. And the bond yields, that cooled off. The US bond yields cooled off by close to around 15 basis points from the highs that we saw a couple of trading sessions ago. All eyes are going to be on that meet between the United States as well as Japan, because Japan holds more than $1 trillion of US debt. So that's going to be important. But this one cooling down, that's good news as well. Moving to the FI positioning. Well, they sold in cash market, close to 2,500 crores odd. But that long-awaited short covering bounce, that's finally coming about. Because we did see that the net short positions went up by close to around 4 times from the start of the series. And they got the positioning right, because actually the index gave off close to around 1,000 points. But in Friday's trading session, we had a short covering bounce. There was close to around 15,000 contracts that got covered out on the short side. And we did have a bit of a bounce as well. So first signs of short covering that we saw in Friday's trading session. Moving to the positioning, the FIs, well, they're still net short, close to around 75% of their positions on the short side. That number was close to around 79%. What did they do on stock futures, though? There was short covering yet again out there from the FIs. They covered close to around 13,000 short contracts. They added close to around 65,000 long contracts out there. And even the client positioning, they added more longs than shorts on stock futures itself. And remember, both the two big participants, they are net long on the stock futures side. Options data comes up for you on the screen. 2 strikes were active, 22,800 call, 22,800 put as well. And just going by both these 2 strikes, there appears there's a bit of a short straddle at play. What's that? You write both the strikes at this, both the call as well as put at the same strike. That's a 22,800 odd mark. And you're looking at a broad range because you're pocketing close to 450 to around 500 rupees. So you add 500 points to around this 22,800 and you subtract that as well. So that's the broad range, but you'll want the range in the near term, right? So given that the GIFT Nifty is suggesting a gap up, in the near term, you'll want the Nifty today itself to conquer the 20 DMA, the 50 DMA as well as around this 23,000 odd mark. So you'll want to close above that mark. The start's going to be in the green. You want to close above that. And going by the options data, the 22,500 mark becomes very important. The Nifty Bank, that's been the driving force. As of now, it's conquered all the technical levels, 20, 50, 100 as well as 200 DMA. So that one will have to drive on from here on and head towards that recent high of around 52,000 odd mark. So yet again, the start's going to be positive. By the end of the trading session, you'll want to end closer to the high point of the day, like we saw in Friday's trading session.
Okay, all right, Nigel, got that. Thanks very much. So those are the cues with which we are starting off. Let's also get you the equity call of the morning. And this one is coming in from Morgan Stanley. Rhythm Desai of Morgan Stanley says India's low beta is helping it to significantly outperform amidst the global sell-off, even while the index could reach multi-month lows. He says key India-specific catalysts include continuing dovish actions from the RBI, stimulus through GST rate cuts, a trade deal with the US, and incoming growth data. He says their new December 2025 sensex target is 12% lower at 82,000, 9% above the current level.
Well, we've got one more call. This is Alexander Redmond of CLSA who says that their base case is now for a Trump-inflicted US recession. He says with record high policy uncertainty, corporate and household confidence cratering, freezing investment and all, but ensuring a self-fulfilling US recession. He adds, forward employment surveys are already deep into contractionary territory, adding within the chaos emanating from the White House, they have sought protection in Asia-Pacific markets with moats for 2025. Okay, well, Cameron Brand is with us, Director of Research at EPFR Global. How are flows looking? Cameron, good morning. Good to have you back on the program. So it's been a momentous week. I think absolutely right up there, right?
It certainly has been one for the books.
So how are flows moving? Could you give us a sense of what's happening? Because it looks like money is leaving U.S. assets very clearly. That is the one trend.
Well, in many ways, the greatest concern seems to be reflected in the fixed income space. Equity flows have been somewhat bipolar. The U.S. and China actually both saw very large inflows last week, though arguably a lot of that had to do with technical factors. There has been some of the reaction you would expect. Money market funds, especially in Europe and actually emerging markets, have seen strong flows. Gold funds have done well. But it was actually bond funds that took the punishment last week, and that included U.S. bond funds. People are still searching for a narrative that they can hang their hat on. But certainly on the equity side, there is a sense that the bond market will impose some kind of discipline on the current U.S. administration. There continues to be faith, misplaced or not, that all of the sound and fury about tariffs is still something of a negotiating position, and when the dust settles, things won't be as far from the old normal as it might appear right now.
Yeah. Cameron, hi. So just to press a little more on this point on bonds, because that really that seems to be what shifted President Trump's mood, right? And then after announcing that 90-day pause, then he said, oh, now the bond market is beautiful. But can you give us some more details of what was this kind of outflow? Where was the money moving out as it moved out from U.S. bonds? And there's a lot of chatter around whether, we don't know for sure, but one of the theories is that maybe China or some of these large other trading partners, maybe Japan, they were dumping some U.S. treasuries, and that kind of forced the administration's hand.
That would be my guess. put it stronger than a guess. We saw just before Trump's decision that foreign domiciled U.S. bond funds had their first sort of serious outflow in really quite some time. And I think for the administration, that was a real warning that foreign appetite for U.S. debt, which is obviously has to hold up to finance these huge deficits, might be beginning to crack. So almost simultaneously with that, we saw the 90-day pause.
Hi, Cameron. Good morning. Good to see you in. What about Indian equities? You know, the FIs have been sellers. They slowed off a little bit. In the month of March, we saw some mild inflows as well. What is your reading in terms of flows to India?
So India was starting to move back into the picture. I mean, the pattern you just described is what we've seen in the fund flows. It's a little bit the market, the forgotten market at the moment, but that's true of almost every market in the world outside the two sides of the major trade dynamic that everyone's worrying about, which is the U.S. And China. But the narrative that brought fund flows back into India last month, certainly continues to be evident in the fund research that I read, that the Indian market is somewhat protected from this because of the relatively low exposure to global trade, that India's market has corrected to more attractive levels, that the policy environment, especially in comparison with ours, sounds very rational and mildly stimulatory. So we did see mild outflows again last week after 3 straight weeks of inflows. But I think when people are able to focus that India, is still not soaring the way it did for the 2 years into the fourth quarter of last year. But investors and fund managers are certainly warming back up to the Indian story.
All right, no, absolutely, and certainly hope so. Cameron, we will leave it there. Thank you very much for coming on with that quick take on how flows are moving. Markets certainly moved quite a bit, but flows is what moved them. Well, let's just quickly run you through the corporate interaction. All interactions are lined up here over the next 2 hours or so. 8:35, you'll hear from the management of Senco Gold. They'll be speaking with us about their business update for the fourth quarter. 9 o'clock, Parthiv Jonsa of Anand Rathi will talk about key trends in the metal space. That was a big mover on Friday. 9:20, Gautam Shah of Goldilocks Global Research on technicals. 9:30, we'll have the management of Federal Bank with us to talk about the implications of the new gold loan norms, which they, of course, with the RBI put out. Tanvi Gupta Jain of UBS will be with us on the macros at 9:40. Trump tariffs in focus, and of course, it's the economy. Lata will be speaking with Santanu Sengupta of Goldman Sachs on the impact of tariff zigzag on India and the global economy.
Well, time to slip in a quick break. We've got a lot of stock-specific action to track for you. We'll get to that in just a bit in our special Top 10 segment. For the time being, I give you a sneak peek. We'll look at HDFC Bank, Oro Pharma, some within our mother Sin, Sona BLW Precision, Tata Power, Ashoka Buildcon, Macrotech Developers, and Transrail Lighting. All of them will be reacting to positive news flow, while Orient Cement and Sula will be reacting to negative news. Slip into that break, come back, we'll get into further detail on all of these names.
So, I mean, right now the regional markets are doing okay. It's just China and Hong Kong which are flat to mildly negative, but other markets are looking all right for the time being. The Japanese market up 1%, Singapore's up about 1.6%, Australia's also higher. So the implied open, anyway, we have to catch up with a bunch of those trading holidays. So therefore, the pop on our screen looks quite healthy at 360 odd points. That's how the implied open is indicating we'll start off. What about individual stocks? Plenty to track in terms of news flow, and our team is standing by with the CNBC-TV18 list of top stocks to watch for the morning. Guys, morning to all of you. Abhishek, let's start with HDFC Bank. Why are you tracking this one?
Well, HDFC Bank has cut, deposit rates on its saving deposit side. So they have reduced saving deposit rates by 25 basis points. This is the first time that the bank has reduced saving deposits almost in, about 56 to 57 months. That is about from June of 2020 to right now. It's the first time that they have reduced saving deposit rates. So saving deposits below rupees 50 lakh will now attract 2.75% interest rate, and above rupees 50 lakh will get about 3.25% saving deposit rate. This was earlier 3% and 3.5% respectively. SBI is the lowest saving deposit rate in the country, giving at 2.7%. So analysts do say that the incremental net interest margin benefit will be about 5 to 8 basis points for HDFC Bank. Back to you.
Okay, all right, Abhishek. Thanks a lot for that. Well, let's hop across to Vinny. She's here to tell us about the news flow on Oro Pharma. Morning, Vinny.
Good morning. So we're expecting a positive start coming in for Aurobindo Pharma today. They've received a final approval, ANDA approval from the FDA, and this is for the tablet, which is called Rivaroxaban. This is the strength is 2.5 mg for what they've received the final approval. They're expecting the product launch to come in Q1 FY26. The estimated market size of this strength of this tablet is around $447 million, and this was as of February 2025, the last 12-month period, according to the data points coming in. Now, other than that, they've received a tentative approval for this drug as well for other strengths, which are the 10 mg, 15 mg and 20 mg. The market size of all the strengths combined is around $8.5 billion for this drug. So big one coming in as of now. That's a tentative approval for the other strengths. So keep an eye out on this one. A large opportunity that comes in for Aurobindo Pharma, especially this drug and tablet is widely prescribed as well. It's used to reduce strokes as well as systematic embolism in patients. So that is important to watch out for in today's reading session.
Vinny, thank you very much for that. Let's talk about autos and auto parts now. Some green maybe. Samvardhana Motherson, Sona, BLW and Focus. Sur is here with details. Good morning.
Morning, Prashant. So in the series of statements by US President Trump related to tariffs, he has made a statement related to auto tariffs, and that especially for imports that these companies do from Mexico and Canada. He has said that he is considering modifying the tariffs of 25% that he had imposed last month and had come into effect on April 3rd. And that 25% tariff, he might modify the tariff because he believes that US car companies need a little bit of time. Now, why this would be important for Samvardhana Motherson and Sona BLW? Because Mexico and Canada currently contribute 30 to 60% to total sold vehicles, that basically vehicles that are sold in the US, and amongst those, GM and Toyota. For GM and Toyota, the contribution is in the range of 30 to 40%, while for Volkswagen, the contribution increases to 60%. And Samvardhana Motherson is one of the biggest suppliers to these companies, and Mexico and Canada form nearly 4% to its total revenue. And for Sona BLW, total revenue that Mexico and Canada form is 2%, and that is the reason it's positive for both these companies.
Okay, so maybe some reprieve coming in for autos helps these Indian auto component makers as well. Got it, Sudarshan. Thanks very much. Let's get to Vivek now. Vivek, you're watching out for Tata Power and Ashoka Buildcon, is it?
That's right, some positive news flow on both of these stocks. So Tata Power is in focus. The company has signed a power purchase agreement with NTPC to set up close to 200 megawatt of firm and dispatchable renewable energy, a capital commitment of close to 4,500 crore. Again, a positive development given the fact that the PPA is in place. The second stock, like you mentioned, is Ashoka Buildcon. Company has emerged as L1 or the lowest bidder. Now, this is for a Central Railway EPC project. The project involves construction of earthworks, bridges as well as civil works. Bid price that Ashoka Buildcon actually bid was close to 570 crore. This excludes GST. Positive development given the fact that the order book now swells up further.
Thanks for that, Vivek. Going back to Vinny, she's tracking Macrotech as well as Transrail Lighting. Vinny, take it away.
Yes, so keeping an eye out on Macrotech developers. Why now? The dispute that was going on between the Lodha brothers, that is Abhishek Lodha as well as Abhinandan Lodha, on in terms of who could use the Lodha as a term coming in for their companies. Now, obviously, that has been officially resolved, so no issue on that front. The overhang that was there in terms of this dispute for Macrotech developers goes off, and Abhishek Lodha of Macrotech developers will continue to have the rights for the brand name Lodha as well as Lodha Group, and Abhinandan Lodha holds the executive rights for his brand, that is House of Abhinandan Lodha. So the dispute has been resolved, and that's why we could expect to see some green on the screen. Transrail, that's another one that we're keeping an eye out on. They've secured an order of around 1,085 crores, and this is in the domestic market. As on 9-month FY25, domestic market accounted to around 46% of their revenues, and this is mainly a T&D order that they have, power T&D segment. In that main segment, they've received this order, and that segment accounts to around 87% of their revenue. So interesting to keep an eye out on. 87% of the order inflow, I beg your pardon. So more orders on that front is something interesting to watch out for.
Thanks, Vinny, for that. I'm looking at Orient Cement. They came out with their set of numbers. The numbers are less important right now because the street will be looking forward to how Ambuja Cements will turn around the company in the quarters to come. Nonetheless, the numbers were disappointing. Top line degrowth of close to around 7%. That's going with the volumes that were down by close to around 3% or thereabouts. So the 3% volume decline on volumes, that means that realizations were weak. They were down by close to around 4% or thereabouts. The problem was that even on a sequential basis, realizations were down by 1.5%. Well, the street was bracing for some kind of increase, maybe 1% or so, because it has a high amount of exposure to South India. So weak realizations was a disappointment. EBITDA number, well, that was down by close to around 30% on a year-on-year basis, but it improved on a sequential basis, which is heartening, because the margin profile as well, from around 9%, it's moved to around 12.5% or thereabouts. So there has been some improvement. EBITDA per ton from around 450 rupees, it's moved all the way to around 600 rupees. So some improvement being seen on a sequential basis, though the street would have liked to see some more. Profitability was down by close to around 38%. So going with red on this one because the numbers were weak. However, that open offer price of around 395 rupees will keep the stock afloat. That said, let's go to Mangalam. He's here to tell us about Sula Vineyards. Well, Mangalam, another weak quarter?
Another weak quarter for Sula Vineyards makes it a weak year for the stock as well and the company. If you look at, over the last 1 year or so, the stock has seen a massive correction from the highs itself, and seems like given the fourth quarter update, there might not be much relief coming in as well, because the total revenue for this quarter grew by just 0.7%, about 132 crores, and that was led by a big surge in their, wine tourism business, which benefited from the Sula Fest that they had conducted in the quarter itself, which grew by about 25%. Their own brands actually saw a decline of 2.9% in their revenues, coming in at just above, just around that 110 crore mark, and taking the entire year's revenue to growth of just about 1.7%, much lower than the over 15-20% that the company would do in the previous years itself. The only thing I will be watching out for, despite muted revenue growth in the actual numbers that are reported, will be margins. Have they improved from their third quarter levels or not? Because that's exactly what the management had told us when they joined us very recently itself. So if the margins are improving, then maybe the next year we will see better growth and there could be some relief. But on these numbers, one expects the stocks to be in the red today.
Okay, so not quite a high. That's Sula at the end of Q4. Mangalam, thanks for that. Let's quickly recap our list of stocks to watch then. The positive ones are HDFC Bank, Aurobindo Pharma, Samvardhana Motherson, Sona BLW, Tata Power, Ashoka Buildcon, Macrotech Developers, and Transrail Lighting. Stocks with negative news flow, not too many today. There's Orient Cement and, of course, Sula Vineyards. Let's also figure out what's happening with commodities. We have Manisha Gupta joining in with a roundup of all the action. Manisha, so long weekend, 3 days, so we have to react to a bunch of cues. What are the headlines for you?
Well, absolutely. I'll start with the crude oil prices, because even as we are 10% down for the month of April, the intraday markets have started slightly on a better note. Well, the US and Iran conversation will reconvene this week. That is what the markets will watch out for. But some reaction also coming in from the fact that the OPEC report that came in yesterday, they have revised down the global demand growth, and they're anticipating a supply surplus in 2025, and that would cap too much gains in the markets there. But a segment that has continued to do well in the Asian markets today also has been the base metal prices. Copper is now up by 12% in last 1 week. Strong gains coming in for zinc as well. Aluminum prices are up 0.5% in the overnight markets. You have nickel prices, which were trading at a 4-year lows, also rebound quite strongly. So whether it is about some easing of tariffs that we've seen coming from US, the dollar index that continues to be on the weaker side, and the Chinese trade data that came in yesterday also was on the positive side. Whether it was about crude imports, metal imports, some of the product exports as well, has been positive for the month of March, and that in turn also seems to be supporting many of these metal prices.
All right, Manisha, thank you very much for that. Commodities and metals, etc. I mean, big moves last few sessions, like equities, like bond markets. And we will continue to track these with Manisha. We'll take a break here. Amnish Agarwal for some fundamental stock conversation on the other side.
Welcome back. You're tuned into Bazaar Morning Call. Well, we've listed on all the top stocks being to track. Let's get some more fundamental analysis going. We have Amnish Agarwal, Director Institutional Research at PL Capital, who joins us on the show. Hi, Amnish. Thanks a lot for joining in. Well, let's talk about the auto stocks. There appears there is some kind of softening in stance from President Trump. That's why we look at a couple of companies like Sambadana Motherson as well as Sona BLW. Your view on the auto pack and the auto ancillaries? What's your top pick from there?
Yeah, hi Nigel. So two things here. As far as your domestic scenario is concerned, I think even the recent FADA report talked about some lower growth numbers for FY26. So a lot will depend upon how the demand goes in the coming few quarters. And the domestic scenario doesn't look to be that great as of now. Now, as far as your stocks like Sona or Motherson are concerned, I think because there has been a realization that US will now give some more time for the auto component manufacturer, the auto OEM manufacturers now to start manufacturing more in US in the longer term. So there could be some sort of a relief which will come to companies like Motherson or Sona because they are exporting to those countries, or for example, Motherson is having base in those countries and drives a lot of production over there. So to that extent, it is positive for these companies. And I think you could see some positive reaction coming on that front. But having said that, on the domestic side, things are it's more like a cash-22 situation as of now.
Okay, so that's on the auto space. Just to talk about some more names, where this tariff hit has been playing out. Now that we know that there is not a rollback, but at least some sort of a partial pause on electronics and semiconductors, Amnish, do you expect any kind of immediate reaction on names like Dixon and Surma? Some of these stocks last week, they ran up in anticipation that China won't be supplying anymore. So eventually Indian companies can come in and take that space. So the US is not a big market for them right now. How are you looking at some of these EMS players?
The main thing is when it comes to EMS also, first of all, what sort of technology level products we are manufacturing. So that is one. And secondly, whether we are having the capacity or the current where with the demand in the US. Now, on both these fronts, I think the Chinese manufacturer or the companies which are based out, say whether it is Vietnam or Taiwan, they are much ahead of us. And India has actually started investing in this only in the, I would say, the past few years. Now, given that we are not a very large manufacturer and the capacity is very limited, can they incrementally gain something? The answer is yes. Can they, you can say, replace the Chinese manufacturer or do something which is very much out of the world, or they can continue growing very fast? For that, I think the scale of the manufacturing that needs to be go up significantly over a period of time. So I think in the longer term, it will all depend upon where the tariffs actually settle. And it is not only for, I would say, India. It depends upon how the countries like particularly Vietnam, Taiwan, Thailand, China, etc. So how the tariffs and the bilateral negotiations there happen. Because if any of these countries which are having the bigger manufacturing bases, more economies of the scale, so if they are able to supply or if they are able to get a better tariff deal, then we might not be having big advantage, and many of these companies then would end up again catering to the domestic demand only.
Okay. All right, got that point. Stay on, Amnish. We'll have more questions for you in just a bit. Let's also get our first management conversation of the morning going. The stock on our radar is Senco Gold, which has surged quite a bit. I mean, forget all the tariff business and the outward-looking companies and stocks. Senco is up almost 40% in the last 1 month, 32% to be more precise. Now, the fourth quarter business update looked fairly healthy, and the management is now guiding for a robust first quarter as well, FY26 that is. To talk more about this, we have with us Mr. Suvankar Sen, MD and CEO of the company. Mr. Sen, thanks very much for joining in. So the numbers are looking absolutely fabulous. I mean, for the benefit of our viewers, I just want to remind them of the update. 23% revenue growth in Q4, 18.4% same-store sales growth. It's looking really good. At the end of 9 months, your studded ratio was about 10.5%. I want to start there. Where is the studded ratio now? Because this is a time when a lot of players are facing intense heat in the natural diamond space, and the studded ratios have been falling, across your peer companies as well. So where are you? And, are there specific separate plans for lab grown that you have? Mr. Sen? I think that feed has just gone down. We'll get him again. But yeah, so I was talking about the studded ratio from levels of just about 5-6% in FY21-22. By the end of last year, FY24, it improved to about 11% for Senco. And as of 9 months, it's at 10.5. And they've done really well. I mean, throughout the business has been very, very healthy. I think the rise in gold prices plays its own part. But it's bright and sparkly here.
Absolutely. And, gold itself, right, like everything else, high to low, gold fell about 8% while the market was cracking. And then it rocketed. It's basically back at all-time highs. So absolutely a fantastic move. Do we have Suvankar back? Okay, I think we'll go back to him as soon as we have him on the line. But Amnish is with us. Amnish, any thoughts here? The gold plays in that sense. On the lending side, and what's the jewelers for that matter? Anything you like?
You see, we cover Titan only in the jewelry space as a part of formal coverage. But having said that, what usually happens is that whenever the gold prices they soften a little bit, then the demand for the jewelry or the gold coins even that goes up. Now, there are two factors which we need to watch out for here in gold. One being that last year we had a very bad first half. That is, I'm not looking at, say, your FY25. I'm looking first half of FY26. Due to monsoons, very low wedding season and all that, we had a very, very bad half for all the companies. So to that extent, I think the numbers in 1Q and 2Q of FY26, they are likely to be far better than what we had seen last year. So that is one. Secondly, if the gold prices remain where they are, I think there is not likely to be. It's more like a left out feeling, but otherwise the gold has been moving up, which gives you the value growth, but the volume growth is unlikely to be very healthy. The third important factor is that many of the jewelry companies which are listed today, so many of them, they are having gold inventory in their books and they are not doing gold on lease, or you can say stuff like that. Now, for those companies, when the gold prices go up, you actually having the inventory gains on the books, which props up your margin. So all the companies which are having gold inventory in their books, I think they will be beneficiary of if the gold prices continue to move up. And the fourth thing is that if you look at the global uncertainty which has now emerged, due to that, the gold on lease charges, which the companies usually pay to banks for taking, you can say, gold on loan. So those charges have also shown a very sharp uptick in the last couple of months. I think it is, you can say, give here or take. There's some you can say some give and takes. But having said that, in terms of the pure numbers, in terms of the growth, I think the first half of FY26 should look far better on a YOY basis, and that will keep the interest alive in the jewelry companies. And I think Titan remains one of the, I would say, the best stocks in terms of, say, balance sheet, corporate governance, and even the recent quarterly numbers were good. And I think from here on, the stock can give you reasonable returns.
Sure. Okay, so you continue to like Titan. I think we've got Suvankar back, so let's go back and get some questions going. Suvankar, what we were trying to understand was, and this is a point that the analyst just made out as well, that for many jewelers, since gold is not a fully hedged commodity, the rise will lead to some sort of investing gains as well. So when you say 23% growth in Q4, how much of that is an inventory phenomenon and how much is actual growth? I mean, actual growth also looks good because same-store sales growth is up 18%.
No, so when you look at the growth levels, you have to see that it is the revenue growth that we are talking about. And here, there is a value-driven growth and a volume-driven growth. So if a gold price goes up by, say, 18%, and the overall value growth goes up by 23%, that means that you will have a volume growth of 4 to 5%. So that is how one has to look at it. And what Sir was saying in terms of the gain in terms of inventory, that is more to do with the profitability of the company rather than the revenue of the company. Because if you are selling at a higher gold rate to the consumer, you need to procure your raw materials at a higher gold price as well. So what really matters is the gross margin. It is only that to that extent that your books that are hedged or unhedged. So the hedged portion is automatically, you have a fixed margin in terms of the making charges that you're buying at a particular price and you're selling, keeping that margin fixed. It is only to the unhedged portion of your books where you have the ability to make an extra margin.
And how much?
Yes.
Got that point. That's what we were trying to understand, Mr. Sen, that how much of your book is unhedged, and to that extent, what could have been the margin boost because of this dramatic rise in gold prices?
So this wouldn't be the right time to talk about the margins, but in terms of our hedging percentage, we stay around 80 to 85% hedged. So that's been the kind of the average hedge portion of the books that we have. So that is the answer to your question.
All right. Hi, Suvankar. Good morning and good to see you. When there was Poila Baisakh, that's the Bengali festival that was there over the weekend. And then we also have Akshaya Tritiya that will be coming towards the end of this month. So a couple of these seasons which are good for gold normally. How was the demand in the past week, since that was the Bengali festival? If you could tell us, was it good enough? And what is your estimate for the upcoming festival as well?
So wishing everyone, Shubho Navavarsha as we call it, because today is Poila Boishakh. That's why you see me, dressed up in the traditional
looking
attire.
Good, Suvankar, looking good.
Thank you very much. Shining like gold, if you may say so. So the way I can see that over the weekend, the interest of the consumers, even though the gold prices are at all-time highs, there is a lot of interest amongst the consumers. We have been doing a lot of activities in terms of taking gold in the money in advance for the particular season and giving the benefit of the lower gold price in the previous month that we had. So consumers have been quite interested. The wedding season continues to remain till the month of June. And, we have the Bangle Festival going on. So I can see that, the ticket sizes, the average selling price or the average ticket sizes have been on an upward trend just because the gold prices have moved up. So 10 grams of gold jewelry will be worth close to ₹1,00,000, which was 70,000-80,000 maybe even 6 months back. So that's been the kind of, consumers are happy that the prices are going up, but it's just that the volumes will take a hit. So that's the way to look at it. And there was a question that you all were asking in terms of the stud ratio. So, the stud ratio for the 9 months was 10.5%, which as we ended the year, it became 10.5 to 10.9%. So just Q4 itself, which I had been, telling everyone that we are seeing a very positive January, February in terms of the increase in the diamond jewelry sales. So the diamond jewelry sales for Q4 was up by 39%, leading to Valentine's Day, the overall wedding season. So I think that, with the price, there is a lot of news that the diamond prices will also start moving up, and it is gradually starting moving up. Consumers are also gradually getting attracted towards buying the diamonds.
Sure. So, Suvankar, just a quick follow-up on that. I'm glad you, brought up the studded ratio. Your studded ratio has been improving. A lot of other jewelers, particularly on the natural diamond side, they're struggling with either flat studded ratios or declining studded ratios. So your improvement is happening entirely on the natural diamond side, or is it also a function of the lab-grown? Because you have a lab-grown vertical as well. Just leave us with a sense of the trends there.
Yes, no, it is with the natural diamond side. The lab-grown is still a very small portion of the overall sales. Plus this improvement that, just to kind of give a more correct perspective, is that from the 9 months, 10.5%, the growth of Q4 has been substantial, leading to a 10.9% overall year on year. But if I look at the previous year to this year, then the previous year, the stud ratio was about 11%. And this year, we've ended with 10.9. So you really don't see much of growth on an overall yearly basis. It is only in the Q4 that you have seen such substantial growth. And I think very positively that this particular financial year, we will continue to see a kind of higher interest and traction towards diamond jewelry, especially with such high gold prices. So for the smaller ticket size items, consumers will want to, buy maybe 14 karat, 18 karat gold jewelry studded with diamonds and stones. So this is how I think, the future looks like.
All right, so Ankur, 10 grams for a lakh now, right? I remember I don't remember the rate when I started working, 2003, but I remember in 2009, it used to be about 8,000. So 8,000 to a lakh.
Yeah. Prashant, I completed 10 years of marriage over the weekend, and when we were getting married, I think it was around 30,000 or thereabouts. So now there was no buying of gold on the 10th anniversary.
We don't have to deal with that problem.
Now you have notional gains that you're sitting on, all the wedding jewelry that's already been purchased, right? That's why women always love.
Daughter and daughter-in-law will enjoy, let's say that.
Okay.
I think the producer is saying that I'm not laughing, right? Yeah. He's focused on the time. So, Ankur, thank you very much for joining us. Appreciate it very much here on CNBC-TV18. Good speaking with you. We'll take a quick commercial break here. We're going to come back. Some technical trading ideas and focus on the other side. Okay, 5 minutes to go for the pre-open session to kick off. We have Sudarshan Sukhani and Mitesh Thakkar who are with us with what they'd want you to do as we kick off another week. A short week, Monday holiday, Friday holiday. So we've got 3 sessions this week. Gentlemen, good morning. Good to have both of you here as always. Mitesh, what's the setup looking like? Steadier, better markets all around the world in that sense. So we will react to that. But what after the gap up?
Yeah. Morning, Prashant. So I think, this gap up will clearly help the Nifty index get past the 22,800 decisively. The upside targets are around 23,150 and then 23,350, 400 zones. I think we'll head towards the second part, the second level, which is 23,400. So even after the gap up, I think if you get a mild profit kind of a dip in the first 15-30 minutes, it's around 50-70 points. I would look at, exploring long positions in stocks as well as indexes.
Okay, all right. So you'll buy even at around, say, 22,950? Is that the level? 22,900 odd?
That's right, Nigel. So I think, assuming that we open around 23,100, I think decline to about 23,000, 23,030 would be the entry point for me.
23,000 odd, you'll want to buy on declines. Got that. Sudarshan, what about you?
Yeah, good morning. See, the short-term trend is up. When the short-term trend is up, usually we want to buy. Now, volatility also is likely to slowly come down. So perhaps we are entering a sweet spot. There is no sense in chasing a gap up. Be patient. Look for a minor intraday dip. It's difficult to quantify, but a 100-point decline from the opening price would qualify as an intraday dip. Consider buying there. Use call options. Keep a 200-point stop loss from wherever you enter. It's difficult to say where the markets will open, but that's the trade. Look to buy a dip.
Okay, look to buy the dip. Got it. Gentlemen, stay on. We'll take a very quick break and then we'll come back with some specific stock ideas as well.
Welcome back. Well, we'll get the pre-open rates in just a bit. It's expected to be a gap up, but as we've been saying, it's not the start. It's going to be the end of today. And Friday's start and end was very, very strong. So the bulls will be hoping for an encore. But let's get our technical experts back with us, Sudarshan as well as Mitesh. Well, gentlemen, we have heard your call on the index. Buy on a dip is something that you're recommending on the Nifty itself. But let's get to stock picks. Mitesh, you go first. What do you have for us?
So, looking at the big gap up, I think all long calls today, traders will have to adjust the levels slightly, with post the gap up. So, for the timing, I have a buy on Grasim with a stop at 2624 for a target of around 27.1020. IDFC First Bank is a buy with a stop at 58.5 for targets of 63.5. Marico is a buy with a stop at 696 for a first target of 735. And Bajaj Finance is a buy. Keep a stop below 88.70. Look for targets of 98.
Got it. Okay. All right. Thanks for that. Well, let's hop across to Sudarshan. Sudarshan, what about you?
Well, it's mainly buying. Ambuja Cement is a buying opportunity. Stop under 530. Axis Bank, I've recommended it earlier also. I think it's likely to be an outperformer. Consider it a positional trade if you want. It's a buy with stop under 1020. My only intraday short is Zomato, where intraday selling can be done with a stop above 225. And I also have Bajaj Finance, as Mitesh had. It's a buying opportunity. It's not just intraday. It's a positional buy with a stop under 8700.
Got it. Okay. All right. Thanks a lot for that, gentlemen. Well, let's focus on the metal stocks. They have seen a big move, big pullback because of the higher tariffs and fears of recession. But you have the US dollar index that's cooled off, which is normally good for LME prices at least. And the domestic steel industry as well has some protection because of the safeguard duty. Parthiv Jonsa, the lead analyst, metal and mining at Anand Rathi Institutional Equities, joins us on the show. Hi Parthiv, good morning and good to see you in as always. Let's get a couple of basic points out of the way. What do you prefer in the metals pack, ferrous or non-ferrous?
Hi, good morning, Nigel. Thank you for having me. I actually prefer ferrous in this set of things, comparing, considering all your global uncertainties around tariff. I prefer ferrous as overall pack, basically.
Got it. Okay, ferrous is preferred. Let's get a little bit deeper then into ferrous before we move to non-ferrous. From the ferrous pack, among the big names, Tata Steel, SAIL, JSPL and JSW Steel. What do you like from the four big majors?
Let me answer this. If you see your domestic is actually growing and, your domestic demand has been around 12.5 million ton even in March, which is, sustaining over last 3 to 4 months. Your domestic story is very robust. In this entire, global uncertainty, noise around tariff, 90-day extension, XYZ across non-metal, tariffs and everything. I genuinely feel companies like JSW, JSPL, which has a massive, domestic presence, should perform well. In addition to ancillary, raw material companies like MOIL, which basically supports all these ferrous sectors, right? So these names should perform well.
All right. What is the target price you have on MOIL? Because I think that was the one that you initiated coverage a short while back. So your view out there, and if I'm not mistaken, I think you also were quite positive on Lloyd Metal.
Yes.
If you could give us target prices on both those two. And do you think after the pullback, is it a good entry opportunity?
Sure. So my target price for MOIL is around $400 and Lloyd's is over 1,500 rupees. That's a target price. Yes, it's a very good opportunity considering, MOIL is like an exclusive or the largest manganese merchant miner in India, and with, almost 2/3 getting imported and they commanding a lion's share, right? And that's the whole story about it with the EC enhancement and the capex going on. So MOIL is a very good level to enter right now. Similarly, Lloyd's. So Lloyd's is also like multiple stories are playing out there, and especially with the MDO business coming in, over next couple of quarters, that would also give a good substantial upside.
Interesting. And the smaller player in there as well, Lloyd Engineering, they are looking at doing a rights issue to help, build that big capacity that they're talking about. So we'll keep an eye on the Lloyd Group companies. A quick question with regard to steel pricing for the industry. Even before the safeguard duty came in there, the prices went up. And then, in fact, you did see that the prices actually, they stabilized. We didn't see another big price increase that came after the safeguard duty. One could say that maybe, in fact, the anticipation was already there. So the price increases were done in advance. What's the price difference right now between, domestic prices as well as landed imported steel?
So if you consider China, I'm considering this 12%, right? So if you consider China, it's close to we are still about 1.5, 2% discount to Chinese landed, and same with your FTA country landed prices. Right now, your domestic is around 52, 53,000 HRC. So that's almost on par with your landed prices. Considering the 12% safeguard duty, if it, potential safeguard duty in place, right? So that's the entire parity right now.
Okay, all right. Let's move to non-ferrous then. Stocks like Nalco, Hindalco, Vedanta, they have got hit very, very hard. Nalco because of the decline that we've seen in alumina prices. But since Vedanta is not backward integrated, it has a bit of a cushion, right? With regard to lower alumina prices, which will be good for their profitability. What's your view on Vedanta first? Given that alumina prices are down, Q4 could be a little bit weakish, but you have a special situation that is playing out. Your take?
Yes, absolutely. The special situation play out especially in Q1, in my opinion. So Vedanta being a non-integrated player out here, benefits the most at the end of the day. Nalco, on the other hand, if you consider alumina to the aluminium percentage, right, it has cooled off substantially. It is now back to its long-term average, right? So here, Nalco is because Nalco, sells a lot of third-party merchant alumina. Nalco is the last one out of the three, right, at the end of the day. Vedanta, because it's a raw material for them, benefits the most. And Hindalco is completely integrated. It's somewhere in between. However, as far as Hindalco is concerned, yesterday there was also this potential tax cut rate in US. If it happens, Novelis would benefit at the end of it, if it happens, right? So Hindalco is also better placed that way.
So among the three, I think Nalco, I guess, going by what you're saying as well, is a bit of an avoid because of the alumina prices are following such a great deal. And we know that Nalco is more play on alumina rather than on aluminium.
Absolutely.
So among the two of them, Vedanta as well as Hindalco, both of them have pulled back a great deal. Vedanta has a special situation. Hindalco has that Novelis trigger, and if things are looking up, then maybe Novelis will not get hit that badly. And also valuation-wise, it looks pretty okay. So your view?
In both,
between the two,
coverage on Vedanta. Yeah, we have a soft coverage on Vedanta, so we do not have a target price there. But absolutely, Hindalco is better placed out here. Considering domestic play on aluminium, it is supposed to grow, substantially over the next couple of years. And even from the Novelis angle, I feel Hindalco is much better placed.
Hindalco is much better placed. And how much of the bad news is in the price for Nalco?
I think it's almost there. Again, it's a soft coverage, so there is no official target price on it, but it's almost at about 140, 145 level. It has come out substantially in line with the cooling of your alumina prices.
Okay,
so
all
what
right.
was going at about 30% of the LME, it is now close to about 14.5% of the LME.
Perfect. Thanks a lot. And I think the long-term average is close to around 17 to 18%, right? Alumina as a percentage.
Yeah. You could say about 16 to 18% is the long-term average.
Thanks a lot for that, Parthiv. Wishing you a good day ahead. For the time being, Parthiv's view is that he's more positive on ferrous in comparison to non-ferrous. He likes stocks like JSW Steel, JSPL, as well as Lloyd and Moyle. While on the non-ferrous side, Hindalco is a stock that he likes quite a bit.
All right, the pre-open session is indicating a very, very strong start. So I think the end of the pre-open, we are about 368. So this would be, we'll clear the 23,057 level, which is the 61.8% retracement of the fall that we saw from the highs of 25th of March to the low that we saw on the 7th of April. And then some. So this is a super, super strong start that we have. 2.33% higher is what we got.
Just one point, Prashant, since we have a truncated week, we'll have to see how much of the domestic participation is there. That's going to be important. And since it's a big, in the West world, since it's a big Christian festival, which is Easter at the end of this week, it'll be interesting to see what is the foreign participation as well, because they'll have a very, very long weekend. They'll have Monday as well because it's Easter Monday. So participation as well is something that we'll track.
And absolutely. Liquidity may be a bit of a casualty because of all these holidays and that we have here and around the world as well. 9:10 call. Sudarshan is back with us with what he wants you to do. Sudarshan, morning.
Good morning. Bajaj Finance is a buy. Stop under 8,700. Manage your opening gap, but it's worth buying.
Okay, Mitesh, what about you?
I'll go to buy on Grasim for targets of 27, 10, 20.
Okay, all right, gentlemen. Thank you very much for that. By the way, look at Samvardhana surging in trade and even Sona BLW. These stocks are up 5 to 8%, and Sud had highlighted this earlier as well in our top 10 segment. Let's go back and check why these stocks are so excited. It has everything to do with US tariffs once again. Sud?
While all the auto stocks are higher in the pre-opening session, but these two stocks are particularly up somewhere in the range of 9 to 10%. And the reason is because over the weekend, we saw US President Donald Trump saying that he's looking, or basically he's considering modifying 25% tariffs that US government had imposed on autos and auto parts effective April 3rd of this year. Now, what he's saying, basically, he's saying that US companies need a little bit of more time. Now, why it's positive, especially for Samvardhana Motherson and Sona BLW? Because he has said that for Mexico and Canada imports, especially he's considering modifying the tariff, and Mexico and Canada form major part of the revenue for these two companies. For Samvardhana Motherson, Mexico forms nearly 4%, and for Sona BLW, it's in the range of 2 to 3%. Now, if you remember, for US sold vehicles and that come from Mexico and Canada, contribution is somewhere in the range of 30 to 60%, while for GM, it's in the range of 30 to 40%. For Volkswagen, it's almost 60%, and Samvardhana Motherson is one of the biggest suppliers to these companies, and that's the reason it's going to be impacted positively. For Sona BLW, it has an assembly base in Mexico, and that's the reason revenue contribution comes from Mexico, and that's why this is going to impact positively to Sona BLW as well.
All right, Sudarshan, thanks very much for that. So these are big moves, gap ups which we are seeing at this point. Devyani International, Interglobe Aviation, Ajanta Pharma, the other names that we want to sort of address. Hormuz is here to tell us why. Hormuz, morning.
Morning, Prashant. And an upgrade coming in for Devyani International from Kotak. They've upgraded the stock to buy 190 rupee price target. And they are saying that they're expecting FY26 to be a better year, led by a pickup in same-store sales growth due to a weak base, some improvement in underlying demand and proper execution by the company as well. And based on KFC's market opportunity, the strong brand equity, the optionality of other brands, the appetite of portfolio augmentation from RJ Corp and a track record of creating shareholder value, it is what is driving their bullish call on Devyani International. Now, Motilal Oswal has also upgraded Indigo to a buy 65.50 price target. They say that the benign crude prices and favorable domestic demand bode well for the company. They are expecting a 28 and 38% EBITDA and profit CAGR over FY25 to 27, and that an upswing in Indian aviation will benefit stocks like Indigo. And lastly, Ajanta Pharma, where Jefferies has initiated coverage with a buy recommendation at 28.50 price target. Not a significant upside, only 11% from Friday's close, but it says that it is getting 70% of its revenue from high entry barrier branded generics markets, which are in Asia, India and Africa, and they are expecting a 19% profit CAGR over FY25 to 27. So positive commentary coming in for Devyani and Interglobe, and an initiation on Ajanta Pharma.
Okay, all right, Hormuz, thanks very much for that. So we'll keep all of those stocks on the radar as well. 540 points. That's the kind of increase that the pre-open Nifty is indicating. 23,368 is where we're at. While the large caps charge away, and it'll be a very wide move today, IT, banks, everything is going to start substantially higher. We'll see how it goes. Even the mid-cap space is looking interesting. We pointed out some of the stocks like Samvardhana, but even names like United Spirits, Just Dial, Balaji Amines, a lot of these mid-cap stocks also up anywhere between 4% to 6-7%, depending on which ones you are looking at. On the index, of course, it's Bajaj Finance and HDFC Bank, along with ICICI Bank. So it's the financials that are leading this bull charge this morning. That's what we had. And that's the point that, I was looking at earlier as well, because if you simply look at the bounce, the V bounce from the lowest point of this whole tariff storm, then US markets had already done more than us. So it was, it was pretty clear that today is a catch-up day. I guess bulls will just want to see that a lot of these gains, these pop-up gains, most of them can be digested and remain intact by the afternoon.
By the way, Surbhi, we will, with this gap up, right, you're essentially going to be back above the Liberation Day levels. 2nd of April, yeah. 2nd of April. We were about... you're going to be there, basically. I mean,
so we've been liberated from Liberation Day, maybe, with this morning.
The Nifty Bank will open at the highest levels in 4 months.
Yeah, okay, all right. So what do we have? It's a decent start, 460 points, 450 points on the Nifty. We've got the sensex, which is up about 1,300, 1,400 points. So these are strong levels to begin the day. 1.7 higher on Nifty. The Nifty Bank is up about 1.7, 51,895, 51,900 basically. The mid-cap index is up about 600. That's about 1.25% higher. The small-cap index will come up on your screens and it'll give you a sense of how we are starting there. 1.2 higher as well. Look at this. I mean, about 100, less than 100 stocks are lower, 1,800 stocks are higher. So the skew is absolutely clear which way things are. Heat map, I reckon all 50 should be in the green, and they are. Everything is up. So Tata Motors, HDFC Bank, Bajaj Finance, and so on and so forth. But all 50 up and about for now. Surbhi.
And Tata Motors is in pole position, 4% on that stock. And look at this whole reprieve on autos where he's saying, okay, I'm thinking of giving the auto guys some more time. That seems to be playing out not just on the ancillary names like Motherson and Sona BLW, but on Tamo itself. Remember, Tata Motors had announced that it is halting all shipments to the US. So investors would want to see if there's any rethink on that strategy. Maybe they'll want to ship more and more cars till the final tariffs on auto kick in. But that's a winning stock this morning. HDFC Bank is the other one. Big move, 3% on the higher side. There's M&M, there's L&T, there's Bharti Airtel. Everything is up and about. Reliance, ICICI Bank contributing about 2 to 2.5% each. Actually, autos even beyond Tata Motors are doing pretty okay. Maruti is up about 2% as we speak. M&M is up about 3%. So autos is a good-looking space. On the downside, no negative stocks on the Nifty, but relatively speaking, consumption is taking a backseat. These stocks had a good couple of days. Today, they're on the lower side of the screen. So Nestle, HUL, Asian Paints, ITC, Titan, all of these stocks are clocking the lowest amount of gain on the Nifty right now. But yes, auto stocks definitely surging higher. Look at Bharat Forge, 5%. Look at Samvardhana and, of course, Sona BLW, as Sur also pointed out. So autos and auto ancillaries in top gear this morning.
Well, that's right, Surbhi. And just to make a couple of more points, Nifty Bank, it's open at its highest levels we've seen since the 18th of December. So good going on that one. The Nifty Bank is the one that's trading way above all technical levels, and that's boosting away. It's up close to around 1,000 points. Macrotech developers, the Lodha brothers bearing the hatchet out there. The street likes it. That stock is up close to around 3% as we speak. So big up move is what we're seeing on that one. A few more names. Intellect Design, that stock is up close to around 4%. So big up move is what we're seeing out there. DLF is up close to 3%. JSPL has bounced back well. That's up close to around 2.5%. Remember, the stock was under pressure post those tariff announcements from the management. But that one as well is flying away in today's trading session. Havells is a little bit lower, actually. A very, very small, minority stake is what they've taken in the company, for around 600 crores. I think that's close to around, 25% of the cash they had in their books. If I'm not mistaken, it was 2,500 crores. Street doesn't seem to be liking it, though it's very, very small in the scheme of things. That stock is down 1.5%.
All right, absolutely. You've got, and volumes will pick up, absolutely. I'm just looking at the big volume-led gains right now. It's all, dominated, of course, by autos. So the Motherson, Tata Motors, Sona Comstar, Bharat Forge. This is, the top 4-5 volume-led gains right now. Coming through at this point in time. PG Electroplast, I think we did mention it, 5.5 higher. There's Goldium International, which was a limit up on Friday, and I think it's up another 5%, 7.5% now, Goldium. Of course, the price damage was severe. From almost 600 rupees, the stock had fallen to about 250, from 250 to 350 now, in about 3 or 4 trading sessions. So that is Goldium for you. And there's Bharti Hexacom, which is up about 4.5%, 5% as well. So that's it. There's nothing very much on the downside at all. I can spot Gravita India, which is down 1% on some volumes, but it's not meaningful. It's largely all up and about at this stage. Gautam Shah is with us. Let's talk about price action and where we go from here. Founder at Goldilocks Global Research. Gautam, good morning. Great to have you with us here. Prashant, this side. Just really one for the history books. What we've gone through over the last 6-7 days would rank right up there, especially as a trader, Gautam. So much volatility and so much excitement, so much drama. But what from here now, Gautam? Do you believe the worst is behind? We're at about 300 right now.
Good morning, Prashant. Well, drama is part and parcel of today's stock market. I think because we live in such a noisy world where there is so much happening. I think since the COVID lows, we've had so many events, whether it's geopolitics or earnings or the Trump trade that has played out in the last 1.5 months. But I think markets need to discount all of that very quickly, which is what markets have done. I think every bear market has two phases. One is that of price correction and the other is that of time correction. I think we ended the price correction last Monday at levels of 21,800 because I think the technical studies, the breadth, the sentiment, the news flow, everything came together to possibly indicate that it was a panic bottom. Thereafter, we've seen very good constructive action. I think the Nifty is up about 1,200, 1,300 points in no time. And I think we've entered a period of time correction. I think a lot of money which was on the sidelines is now at work because I think participants believe that most of the negatives are discounted. So that's the reason you are seeing this very good looking flamboyant rally. But I would not read too much into it. I think 23,400 and 23,800 are numbers to which the Nifty can move to. And broadly over the next 2.5 months, I think we are going to stay in a sort of a range. We will not make significant we will not see significant upside or significant downside. But between now and the end of the year, I think it's going to be a stock pickers market. Just be in the right stocks, in the right sectors, and in the right themes. I think there is money to be made on the long side. So I do believe that the worst was over at the recent low because I believe that the charts are well placed on the weekly and on the monthly time frame. And I think a large part of the news flow has already got discounted. I guess it can't get worse than this.
Sounds good. Sounds good. Gautam, can you just repeat the Nifty targets for us? So by December 25, where do you see the index?
Well, Surabhi, it's not about the index. I think let me just reiterate that because I feel that it's going to be a stock pickers market between now and the rest of the year. But still, if you want numbers, I think 23,800 to 24,000 is where we can move to in the near term. Can we go beyond that? We can definitely go beyond that and see much significantly higher levels. But I would like to cross the bridge when it comes. I want to work with a bullish mindset. I want to buy the dip now because in the last 6 months, it's been a case of lower tops and lower bottoms. I think over the next 6 months, it's going to be a case of higher tops and higher bottoms.
All right, Gautam, you mentioned numerous times out there, it's going to be a stock pickers market. What's looking good on the charts? Give us a few stocks.
Well, anything that has relative strength and anything that did not make new lows last week is something which is on top of our list in terms of longs. And I think on top of that list is financial services. I mean, if you look at the Bank Nifty, today it is at levels of 52,000, which I think is an important resistance. And once this is taken out, I think it might be the first index after financial services to actually make new lifetime highs. So I remain bullish on the Bank Nifty, and I think there are immense opportunities. And the way some of the top banks handled the recent weakness itself was quite commendable. I think I spoke about it in our last interaction as well. So we are very positive on the entire financial services space. I think it will go on to make a new lifetime highs, followed by the entire PSU basket. You know, I'm actually refraining myself from staying away from any company or stock that has something to do with foreign soil. Because in today's world, you don't know, what can come out of where. Even though the markets are all good today and autos are doing well, I'm still very comfortable with the PSU as a basket, valuations-wise, chart-wise, ownership-wise, and I think it could be one of the standout performers for the rest of the year. And finally, I think metals. It's been my favorite for a while now. Yes, it saw a bit of a dip after the market weakness, but I think it's setting up really well right now, and I think a 10 to 12% move on metals looks quite likely.
Okay, those are some very interesting ideas and observations, Gautam. So you're saying PSUs are still looking good to you. Chart structures are still positive. Metals 10 to 12%. And can you dive a little deeper in financials? I mean, is everything looking good? Is it more banks? Is it private PSU, large NBFCs? I mean, what within financials looks the strongest?
Well, gone are the days where you could buy into anything and everything. I think we had that phase for about 2.5 years where you bought anything and you made money. I think with this correction of the last 6 months, the men have been separated from the boys. And if you really see, top quality has stood out. I mean, a case in point being what HDFC and ICICI have done versus an IndusInd Bank and maybe some of the other smaller banks in the market. So I'm staying with the industry leaders and challengers, the big boys in each of the sectors. I know the screen looks great today and everybody will suddenly become very optimistic. But I think let's have a realistic view on the markets. And therefore, I want to stick to the big names. So the top 3 banks, the top 2 NBFCs, I think they stand out for me and I think they'll do very well.
Top 2 banks and top 3 NBFCs. So you'll stick to the larger names within banks and non-banks. Just a word, since we're talking financials, what about these capital market stocks? I mean, they were also the poster boys and poster girls of the rally up until September, right? Brokers, wealth managers, etc. What do the charts say here now?
Well, I do believe that equity markets are not running away anymore, which means that it's going to be a huge challenge for the Nifty to go out there and make new lifetime highs. I do believe it will happen, sometime over the next 12 months, but I'm not preparing myself for the same. In that kind of a range-bound environment, I'm not very comfortable with the capital market stocks. I think capital market, defense, railway were themes that did very well in the last 2.5 years. I think that the newer themes have emerged in the last 6 months, which you would have noticed, and that's the reason I'm sticking to some of the other names. On the other hand, I think real estate is one sector which can really come back very strongly. I think it witnessed a large dip. It's a structural story. A lot of stocks are at long-term supports, and the top 4 or 5 names in the real estate space have the potential to deliver about 20 to 25% from here. So I would be very comfortable buying into real estate at these prices.
Okay. All right. Gautam, you mentioned about the financials and the Nifty Bank. What are the levels we should track out there? The Nifty Bank now is holding about 52,000 mark. The last time we saw this level was on 18th of December. At around 52,500 is what we saw on that day. Where is it headed?
Nigel, the interesting data is the average decline on the whole of NSE in every single stock is about 42%. That's the kind of bear market that we've witnessed in the last 6 months. In the earlier times, this could have happened over the last it could have happened over 1.5 years. So I'm sure there's another camp of people who believe that this is going to stay for the next 6 to 12 months. But I think what could have happened over 1.5 years has happened in 6 months. I think that's one key point. Secondly, I think the way HDFC Bank has held out in this terrible looking bear market of the last 6 months is quite commendable. And this is where smart money seems to be hiding. So I do believe that some of these top stocks will do well, and therefore the bank Nifty can easily move towards a level of 55,000. And if you have to think 18 to 24 months, I think a 60,000 number, which we have been working for almost 12 to 15 months, it remains on track. So I think as investors, you should be positioned for that number.
Okay. All right. Got that. So the Nifty Bank is the one that's revving up the engine. HDFC Bank relatively underperformed when the markets were going all guns blazing. And when the markets dipped, actually, it was holding its own. And that was the pocket to hide in, as Gautam mentioned. Gautam, let's shift focus a little bit away from equities for just a bit. How is gold looking on the charts? Where is that one headed? Because all that glitters is gold. Just take a look at the way that one has moved.
Yeah, it's been quite a glitter, Nigel. And I think every single time I've been on your channel in the last couple of years, I've spoken about gold beating the Nifty benchmark returns. And I think that's played out so far. And I think it's going to play out over the next 6 to 12 months as well. Because I don't see more than 10% upside on the index, even now, despite today's good-looking rally. But in that context, I think gold continues to be very strong. It is at our medium-term target of 30 to 50. It's looking slightly toppish here. And I think the market might just get into risk-on mode. So gold and silver could take a bit of a backseat in the near term. But if you have to take a 12 to 15-month view, I think we are still looking at lofty targets of as high as 37, 3,800. But near term, I don't think today's prices is an opportunity. I think a 5% dip could come by. And if that comes by, I think go long. And as investors, you stay put. You don't try to trade gold because it's a mega trend. It will do well. On the other hand, I think silver is a bigger opportunity. I think that is likely to stand out over the next 1 year. And not to forget what NYMEX crude has done. After almost 2 years of range-bound activity, it's broken 65. Looks like there is another 10% downside coming on NYMEX crude. And talking about external factors, dollar index at 100 at levels of 100, I think another 3-4 percentage points downside is likely there.
And that is on the dollar index?
Yes, please.
On the dollar index, 3-4% down. So dollar index, we're looking at a level of 96, 97 odd. On crude, if I got that correctly, that could be another 10% downtick even from here. And silver could outperform gold. What are the levels on silver, Gautam? Because, silver has been holding in this vicinity of around, I think, 29 to around 34 or thereabouts. It's been very volatile, but we have seen in the past when silver gets its act together, it outperforms gold. So where is that one headed?
Absolutely. I think silver took a bit of a backseat given all the problems around economics and inflation and recession and, all the talks around it. Maybe that's the reason it's not done as well. But I think 29.30 is a nice long-term support for silver in dollar terms. And I think if all goes as per plan, I'm looking at a number of about $43 to $45 over the next 12 to 15 months. So that's a nice 30% move even from these levels. So if you're taking some profits in gold, might be a good time to top up in silver.
Okay, so book profits in gold, buy some silver. That's helpful advice. But Gautam, what about the mothership, the mother market? I mean, look at what's happened, right? I mean, what drama over the last 2-3 weeks. So given the violent nature of the US market correction, but then the recovery has been equally dramatic. So are chart structures kind of damaged? Are they okay? Are they looking okay? And then definitely a word on the US 10-year, because that's where there was sudden panic. The yield hit 4.5%. Is the worst over, or is there some slightly longer term damage here?
Well, it's violence everywhere, Surabhi, whether it's our movies or whether it's the stock markets. I think that's the way of life today. And I think markets are just too fast because of this flow of information and AI and social media. And I'm not surprised that this is the kind of world that we live in. I do believe that the Dow found a bottom at that level of 37,000. 45,000 became 37,000. 37,000 is a long-term support. If you go back in history, 2021, 22, 23, you will realize that around 37,000, there was a lot of support. And I think there are some positive divergences that have developed on the charts. And when I see some of the top names, Apple and Amazon and Alphabets and some of these stocks, I do believe that the worst for the time being is over for the US markets. So I think we are entering into a phase of extreme noise to some stability. And that's the reason even the US markets are likely to go through some time correction. In fact, as we speak, in a week from now, we are actually launching our US product because we believe that there are immense opportunities in the US markets, even from current levels after the recent damage. So I would be constructive on global equities in general, led by the US markets.
Violence in movies. What is the...
we're used to, but the stock market violence was, unnerving.
What is the last 7 days in the market? What movie does it resemble? I mean, I don't know what the last action movie we've had.
Not that I saw all of
I didn't see Sikandar, so I missed it.
What about Godfather? Make an offer you can't refuse.
Yeah.
All right, I think we'll wrap it up here. Thank you very much, Gautam. Appreciate. I don't know if you have a movie which you want to put out, what it looks like, but maybe. Sorry, go on.
Well, I just saw the Sunny Deol one over the weekend, and that's where the violence part came from.
Which one?
Which one is this? I don't know.
This is Jat of Sunny Deol.
Jat. Oh, lovely. Okay. All right. Thank you very much for that. Appreciate your time here, Gautam. And we will, of course, speak again soon enough. I think, guys, we have the management of Federal Bank ready with us.
Yes, we do have the Federal Bank management to talk about some of the important policy announcements that came in the last MPC meeting. The RBI last week published a draft regulatory framework for lending against gold. It is proposing 75% LTV ratio along with tighter valuation and purity norms as well as and also more audits. The RBI has also floated a draft paper to expand the scope of co-lending arrangements to all regulated entities. So two separate regulatory sort of paradigms playing out here. To talk about this, we have with us Mr. S. Harsh Dugar, ED of Federal Bank. Mr. Dugar, thanks very much for being with us this morning. So we just wanted to understand what each of these developments could respectively mean for the sector. Let's actually start with co-lending, which is now being made a lot wider. It's not just priority sector, it's being expanded to all sectors and all regulated entities, banks and NBFCs. So from a business standpoint, who stands to gain here? Small banks, smaller NBFCs? I mean, how does it work out?
So good morning and thank you. Yes, the draft guidelines, when you look at it, there has been a couple of changes and that actually will work good for the sector as a whole. If I have to just enumerate what are the changes which will be actually quite beneficial for the sector, the first one, as you rightly mentioned, it includes all asset classes earlier compared to what the focus was on priority sector assets. Second, they've included many more regulated entities, which was not the case earlier. Apart from that, there are three other cases which they have brought in. The minimum retention ratio is no longer there. So you can technically have a co-lending model where there is co-lending together or it can also be for sourcing and servicing as well. So that actually widens the scope. Other two things which has come up is the default loss guarantee, which was not there earlier, which brings more skin in the game. That DLG of 5% is also going to help both the parties in terms of catering to the segment. And the last of all, which is the CLM2, at this point of time, and what it appears from the draft guidelines, that the CLM2 will not be available as an option, which was there earlier. So these are the 5 major differences which is there. But if you look at it from the entire perspective, I think it's going to be significantly beneficial in terms of reaching out to the deeper geographies, to those borrowers who are less served by the formal banking system, by the NBFCs and banks coming together. So I think this is going to be a move in the right direction.
Do you see this having any meaningful impact, even if it is a couple of basis points, on overall credit growth? I mean, the last year we were kind of stuck in that zone of around 10-11% system-wide credit. If co-lending takes off in a much wider and deeper manner, given these draft norms, what impact does it have on total credit offtake?
It will have a not a very significant impact because it's still in the initial stages, so it will take some time for credit offtake to pick up if I have to look at the CLM model alone. However, the good part which I have to understand over here is that the deeper geographies, which can be catered by the two kind of lenders who have presence the deeper geographies and people who have deep lending pockets, can actually benefit the borrower as a whole. So that is one significant part. It can bring down the costs for both the parties because it will be a shared arrangement. So from that perspective, it's quite beneficial for the system as a whole.
All right. Hi, Mr. Dugar. Good to see you, and thanks a lot for speaking to us here on CNBC-TV18. I want to ask you about RBI putting the draft paper on gold loans for NBFCs. Now, this provides an opportunity for banks. For you, I think it's close to around early teens, if I'm not mistaken, as a percentage of your total book is towards gold loans. Could you tell us what is the current exposure? And if you see this as an opportunity, will you think of scaling up this business?
Yeah, first of all, let me clarify. There's been a lot of chatter going on regarding that this will impact the banks less compared to NBFCs. So this is, if you look at it from a bank's perspective, it's actually quite beneficial. First, to answer to your question, we have a portfolio of about 30,000 crores plus. It ranges between 12 to 13% of our total lending portfolio is actually gold, and we are the largest private sector player in this segment. And we take pride in saying that we do understand the segment reasonably well. So that is one part of it. Coming to the other point about the draft guidelines, there are two major things which has come up. The draft guidelines seeks to do 3 major things. One, it has simplified the overall. There were 32 circulars, which is kind of being clubbed into one single draft guideline as it comes out. So it will make things simpler. There's no cross-referencing. There'll be no interpretation issues. So that's one part. The second part, what they have done is they have standardized it. The auction process, the notice period, valuation process, notice to be given, return of jewelry. This is actually good for the sector as a whole because from the customer's point of view, and please understand that at this point in time, the customer is the ones who does not have access to formal finance, and that's why they typically resort to gold loans, most of it, if you ask me. So it's also essential that their interests are taken care of. There's adequate customer protection, there's transparency, which is what it brings about by making the rules more standardized. That's the second one. The third and the most important one is the harmonization across regulated entities. So you have banks, you have NBFCs, you have other lenders. Over here, it has harmonized the rules and regulations, so there's no regulatory arbitrage or a play between different set of guidelines for different regulated entities. So this is going to be extremely beneficial. So now coming to the 2 points which I was talking about as to why it will benefit the banks. The first part is that it's a question of comparative, not absolute advantage or disadvantage, but comparative advantage or disadvantage. So banks were in any case following many of these guidelines, and more so the LTV to be ensured during the entire tenure of the loan. Some regulated entities were required to maintain LTV at the origination of the loan, whereas banks were to do it during the entire tenure of the loan. Now, this has been harmonized. So from that point of view, it is actually beneficial for banks. That's one.
Correct.
Please
go ahead, sir.
Yeah, the second part is that it is regarding the, they have classified this into 2 categories, consumption purposes and for income generating purposes. And if you ask me, this is actually a very, very positive step initiated by the regulator, mainly because the the industry should be encouraged, the sector should be encouraged to take loans for productive income generating purposes. And over here, they widened the scope. Earlier, it was used to be given for farm credit and largely agricultural loans. Now, the scope has been widened for any kind of an activity which is income generating in nature. So this has been where LTV rules will not apply. So, except for NBFC, it's been capped at 75%, but banks don't have this cap as long as the assessment and the repaying capacity is done in a proper manner.
Right. No, that's very, very well explained, Mr. Dugar. Good morning, Prashant here.
Hi, Prashant.
Actually, the sense that this is, of course, all sort of informal, but the indication that we got, actually, a reporter got, was that when this was put out, right? I mean, and if you look at the market reaction, the largest gold loan company, Muthoot, the stock sold off very aggressively. So, but as you said, I mean, and you were also in a state where, I mean, you're based out of a state where gold loans are a big thing, and you know that business, just like Muthoot does or others do, right? Who are based out of Kerala, who've been doing this for many, many decades now. But the sense we got is this is actually more aimed at not the specialized players in this space. It's actually based, these are directed towards banks, actually, who've grown their gold loan portfolios in a very aggressive way. The net impact, as you describe it, may well play out. But do you think that makes sense, logical sense? I thought so.
Prashant, if you ask me, any sharp growth in any sector or by any bank is something which people tend to envy in the bank, also tend to look at it so that there are no hidden skeletons or issues later on which we may face. Now, the good part over here is that gold, while it's a very safe business, it's an operationally intensive business. That's number one. Number two, if malpractices are there or lack of transparency is there, it comes at the cost of the consumer or the borrower, who are typically, like I said, the ones who do not really have access to formal bank finance. So it is essential that these kind of guidelines are standardized, so there is no scope for interpretation or implementation of these guidelines. And that's a very key thing. So that's what the draft circular does. It kind of, like to give an example, the valuation of gold, it's very clearly identified it has to be a 22 carat. It has to be 30 days average or the last day's price, whichever is lower. It's very clear about it. Or where can you take the price from the IBGA or the commodity exchange? So the standardization and uniformity which comes across for the sector is actually, if you ask me, quite a welcome move. The problem is not about guidelines being stringent. The issue is about it being uniform, both in terms of understanding, application, and interpretation. And if that is done, it gives a level playing field to all the players and the people who can have good processes in place and do this in a manner, it's going to be beneficial for them. And that's the reason why we as a bank are quite welcoming.
No, absolutely. That was an important clarification point, Mr. Dugar, that you made, that the LTV norm will be applicable not just at the time of origination of the loan, but throughout the life cycle of the loan. So that perhaps kind of, reins in any kind of excesses that get built in as gold prices fluctuate. So taking forward what you said, give us some sense, say for Federal Bank, out of your total book, how much is gold loans now as a percentage? And in terms of market share, are you confident of winning over market share from some of the NBFCs now that the rules will be absolutely uniform and harmonious across both banks and NBFCs?
Okay, so to your first part, our share in gold as a part of our total advances is about 12 to 13%. And that's where we are at, largely in the last few years. We are quite bullish on this business because we do feel we have a reasonably good understanding. What we are looking at it in terms of these rules coming in, which is something which is being talked about since the last time RBI came on 30th September, that a harmonized set of rules and regulations will actually be beneficial for all the players. And the players who have strengths in that will actually leverage. To answer your question, will we gain share? Most certainly we would like to gain share, not just in gold business, but in all other businesses of ours as well. But gold in particular, we do feel that we have a strong edge. Our understanding is reasonably deep. We have a reasonably good branch presence, and we have a strong customer base. So basis all these things, I think it's a positive for the bank.
Okay. All right, Mr. Dugar, we'll leave it on that note. Thank you very much. Very helpful conversation. Didn't speak too much about the quarterly update, but we'll talk more about earnings and all the usual ratios, I think, once the official numbers are out at the end of Q4. Thank you.
Thank you so much.
We look forward to that as well. Thank you. Thank you very much. for that. Quick break right now. We will come back on the other side with more corporate conversations, and also we'll put the spotlight on the macros, the impact of Trump tariffs on India. Tanvi Gupta of UBS joins in.
Welcome back. Let's talk about Trump tariffs and the implications for markets around the world. And we have Tanvi Gupta Jain, Chief India Economist at UBS Securities, now joining in to help us with this. Tanvi, good morning. Good to have you with us back on the program. Prashant here. Market odds for a US recession are still around 50%. So it's like a coin toss. What is your global team at? Where is your global team at in terms of assessing the risks? And what then are implications for EMs and specifically India?
Thanks, Prashant. Thank you for having me on the show. So clearly, I think the global uncertainties have increased manyfold since President Trump has announced substantial widespread tariff, including India. So we are seeing 50 to 100 basis point downside on our global GDP growth forecast. Specifically coming to US alone, if I look at the forecast for US, our US economics team has downgraded its GDP growth projections from 1.6%, this is quarter four to 0.4% for 2025. If I look at in terms of annual GDP numbers, our US team is now projecting the real GDP growth to slow from 2.8% in 2024 on year-on-year basis to 1.5% in 2025 and further to 0.8% in 2026. So we are still seeing a substantial slowdown, not a recession yet. If I look at China, which is one of the most important countries when I'm looking at EM and definitely for its impact on the emerging market economies, including India, we did lower China's GDP growth forecast to 3.4% today morning for 2025. So clearly, I would say that we are seeing substantial widespread tariff, and this is going to have a substantial impact on the global GDP growth. So when I come back and look at where is India, I think the economic impact will depend on whether these tariffs, how long these tariffs are put in place and whether they are reduced through negotiations. So I would say there are a lot of margins of adjustment that matter, including retaliation, which we are seeing for countries including China, the margin and the FX adjustment and the elasticities of demand. For India, we did reduce our growth forecast for FY26 to 6%. We were earlier at 6.3%, and our 6.3% forecast were already building in 25 to 30 basis point downside of the tariff hike, which we were already pricing in. So clearly, we would say that the substantial impact of the global tariff is definitely being seen in a much slower growth in India. And not only that, I would say within EM, I would say India looks like will be one of the least impacted countries just because we are a more closed economy and a less open economy, but we are not India.
Okay. Tanvi, so hi, thank you for joining in. Great to have you on the program. So, the range has been around 30 to 60 basis points of an impact on India, and you were outlining some of your estimates as well. Within some of the larger exporting sectors, do you see any bigger hit at this point in time, whether we talk about pharma? The thing is, we don't even have firm final numbers for sectors like pharma or even some of the other plays as of now.
If I look at sectoral breakup, I definitely see that there's a lot of room for negotiations. I mean, the bilateral trade agreement talks are already on, but the sectors where we can see a hit and where the negotiations could also take up strongly are agriculture, electronics, automobile, energy, textiles, and alcohol. And these actually account for 50% share of India's exports to the US. I would also say that at this point, India can definitely increase goods imported from the US, including defense and energy. I mean, the biggest and the easiest part that India could do in the interim by the time bilateral trade agreement comes into force is to start substituting the demand of oil, which we are already coming from Russia, maybe some part from US, and that can clearly reduce the trade surplus, which India has of $46 billion significantly over the coming months. So clearly, I would say the sectors which are going to take impact are the export-driven sectors. But more than that, which I think when you look at US trade tariff and its impact on India, it's not only the slower global growth or the bilateral tariff. I think the biggest uncertainty or the numbers where I see downside is that there could be a postponement of India's private corporate capex recovery due to the risk of China offloading excess capacity to other countries. And that is the biggest concern which I will have, that the investment cycle recovery may get further delayed. From an India standpoint.
Indeed, Tanvi, that's the risk, right? Private sector capex not picking up as much as expected. Got that. But, one positive from this entire tariff tantrum that we've seen from Trump is that crude oil prices have cooled off, which from an India market perspective, it's obviously a positive. And I was listening to the RBI governor last week. He was sounding more growth-oriented. Given that sort of a backdrop, what are you all factoring in from the RBI for the remainder of this year? We've already got a couple of rate cuts. Have you all upped that estimate?
Sure. So if you look at, I think the biggest silver lining, as you rightly pointed, is that oil prices could remain lower for longer. We have taken now $65 a barrel in our growth forecast versus $75 a barrel, which we were pricing earlier before this tariff talk started. Clearly, India is still importing 87% of the oil requirement. So any lower global oil prices definitely bodes well for economic growth prospects. And that is marginally is an offset when I look at my 6% GDP growth numbers. So the downside could have been much larger, but there is an offset because of lower global oil prices. We definitely think that there is additional policy support needed to sustain domestic growth momentum. And looking at that, the fiscal space is quite limited, and the government already came out with a fiscal consolidation rate part. But I think where we could see some kind of fiscal buffer helping to sustain domestic growth is lowering of retail prices of gasoline and diesel in case lower global oil prices sustain. I mean, clearly a $10 a barrel decline in oil prices, if it's sustaining, can give you a room of at least 5 rupee a litre cut in gasoline and diesel prices over the course of the year. Coming back on the monetary policy, I maintain our view that monetary policy will do the heavy lifting to support economic momentum in this downturn. We were earlier building in 75 basis point of rate cut, and now we have revised it and calling for a 125 basis point easing in this cycle, which means that out of 50 basis point, which has already happened, we are building in additional 75 basis point of rate cut, which will bring down the repo rate to 5.2% by end of FY26.
Got that. Tanvi, have you looked at sector by sector that point that you made that private sector capex may take a hit because China has so much excess capacity to sell? Because of that, which sectors could be at risk, and you think we will need to enact, like we've done in steel, anti-dumping sort of measures for a variety of sectors? Do we largely have that protection? What's your sense?
Okay, so first of all, when I look at the sectors, definitely I would expect some safeguard duties by the government to protect the domestic industries. But I think in a globalized world, it is very difficult to control beyond a point. So even though safeguard duties can be put in place to ensure that excess dumping could be avoided, but in the end of the day, if there's so much elevated global uncertainty and if there's a private corporate player, they will think twice before investing. So clearly, I mean, safeguard duties can help a bit, but whether it can substantially change a private corporate capex incentive to invest, I think I've found it very difficult. In this entire mayhem, I think the sector that should do well when I look at India's growth from a broad macro perspective and looking at consumption, investment and exports, I seriously think that the household consumption could remain largely supportive. I mean, it is largely domestic demand driven. We are already seeing cyclical rural demand is recovering on good crop prospects. So far, the weather agencies are talking about normal monsoons for 2025 as well. Urban demand, at least the lead indicators, are showing some stabilization, largely on softening inflation and prospective rate cuts. So I would say, and So I think if the investment is going to see more postponement, and we do see that the goods export could take a meaningful hit due to slower global growth, the sector of the economy that should held up is basically and largely household consumption, which is a significant portion of India's overall economic growth.
Okay, all right. Thank you very much for that, Tanvi. Thanks for weighing in and giving us some sense of the implication that these US tariffs could mean for India. So that's the view coming in from UBS. Back to the market for now. Let's take a look at what the screen is telling us. We've still got, this nice 500-point kind of a move. So it's a steady morning so far. Look at that, rock solid and steady as of now. It's a good-looking screen. We're putting the spotlight again on the auto space because autos are supercharged, turbocharged, so to speak. A lot of those stocks, including, let's actually check out Samvardhana and Tata Motors, etc. Samvardhana is up about 7%. Sona BLW is up about 7.5%. And Tata Motors from the large cap space is also up 4 to 4.5%. Let's quickly get, I think we've got Sudarshan back with us to revisit why specifically these two. I think, do we have Sud?
Yeah. So
Yeah, go on, Sud.
So auto is the biggest outperforming sector in the first hour of today's trade, and the reason is over the weekend, US President Donald Trump has announced that he might consider modifying 25% tariffs that US government had announced on autos and auto parts effective April 3, and especially for the imports that US companies do from Mexico and Canada. Now, the question here would be, will he consider modifying tariffs only on the imports from Mexico or Canada, or also it would be eased for other imports from UK and from other countries as well? But talking especially about Samvardhana Motherson and Sona BLW, for Samvardhana Motherson, Mexico forms nearly 4% to its total revenue, and for Sona BLW, total contribution is in the range of 2 to 3%. From Mexico, that Mexico production, in the US, the vehicles that are sold in the US, the contribution is somewhere in the range of 30 to 60%. For GM and Toyota, General Motors and Toyota, that contribution is in the range of 30 to 40%, while it's the highest for Volkswagen, which is 60%. And why for Samvardhana Motherson it's positive? Because it's one of the biggest suppliers to these companies in the US, and that's the reason you are seeing big move in all the auto names, and especially in these two counters.
All right, Sudarshan, thanks very much. Got that. Let's actually take this discussion forward with Hemal Thakkar, who is a senior practice leader and director at Crystal Intelligence. He's with us on the show. Hemal, thank you very much for joining in. So from a market perspective, there's a big relief rally playing out on all kinds of stocks. OEM, exporters like Tata Motors, which obviously see US as a big market, as well as the ancillary companies. What did you make? I mean, right now we're only guessing, right, till there's a formal order. What did you make of President Trump's statement that I think the auto companies need more time till they can make here, as in make in the US?
Yeah, of course, auto companies will need more time till the time they make in the US. And US has been largely dependent on Canada and Mexico, which are its neighbors, and other countries, from an import perspective, including the likes of India and China. If you look at it from India's perspective, almost 30% of India's exports are to US. So to that extent, it may get vulnerable. But I don't think, supply chains can be built overnight. It will take time. This is more of a structural shift, even if it has to take place. So at this point of time, I say we'll be on level playing field, and we may possibly not see much of an impact, in our exports to US, at least in the near term, is the sense that we are able to.
Okay. So, this relief rally that we're seeing within stocks, is it well placed? Because again, in all the tweets, he also reiterates that eventually it all has to be made in America. But obviously, I think he's also finally realizing that supply chains don't move overnight. So do you see the Indian auto ancillary space remaining fairly insulated, considering the on-ground realities?
Yes, at this point of time, structurally, it seems that we are going to be fairly insulated. I don't see much of an issue. I would see US continue as one of the largest market for us as such. And, the exports will not get impacted to a great extent. Because if you also look at, the statements that the President Trump has been making, it seems that India may possibly stand at an advantage as compared to the other peers, barring, the likes of Mexico and Canada. for that matter. So India may stand to gain. And also, if you see in the last 3 to 4 years, we have had significant increase in share to US as compared to what it is today. So from that perspective, it's going to be a positive to India. And also, if you ask me, the cost and the quality, kind of combination that India can provide to US at this point of time, which is very much acceptable by most of the large OEMs there, is something which may not be, a competition from other markets as such. So I think India will definitely stand to gain from that perspective.
Hemal, what is the risk to this view? What's the argument if we can approach it from the other side?
What is the risk to the? Sorry,
what is the risk to this view that India largely benefits? Go on.
So as Surbi said, supply chains, if they get rewired overnight, or if there are tariffs which are relatively lower on China as compared to what it is for India, then, you may see India being at a risk. But till the time we are better off as compared to, our counterpart, I think we are, in a much better position, because the only option that US at this point of time would have apart from India would be Mexico and Canada for that matter, apart from China. And if Mexico and Canada are also at a level playing field or a little better than us, but still the kind of volumes that they need, they will definitely need India to support the auto OEM industry that is there in US.
Hemal, just a very general question. I don't know if there can be a clear answer to this or not, but assuming that some level of tariff will eventually come in, maybe not right now, maybe 2-3 months later, whether it's 15% additional tariff or 20% additional tariff. I mean, India's original number was 26%. So let's see, 15-20%. Maybe if that does become a reality, do auto suppliers and component suppliers, do they have enough margin cushion to digest some of it? Or will all of it have to be literally passed on to the end consumer, and then we deal with demand fallout as it happens?
Yeah, both could happen, Surbi. I'm not trying to give you a politically correct answer, but today most of the auto component companies are having margins in the range of about 10 to 16%, depending, on the segment to which they are catering. So the EBITDA margins are in that range. So from that perspective, they will definitely have some cushion, wherein they could absorb a little bit of increase and pass on the remaining to keep the demand active. But as I said, what I still believe, or what Crystal still believes, is that, we are in a much better position when we look at our counterparts. So what sense we are getting is, we'll probably be levied relatively lower tariff as compared to, the strongest competitor that we have will be in the name of China. So from that perspective, if we are relatively better positioned, I think we should be in a position to pass on the, kind of increase that we have because of duties, and should be in a position to protect our margins.
So since you're saying that the only real threat is from China, and going by nomenclature and the language of the social media posts, where President Trump is calling China the biggest abuser, I guess we're okay. We're in an okay space. But let's see. This is a fluid situation. Every day you wake up to something new. But thank you for weighing in on the situation as it stands today, that perhaps Indian auto component companies don't have too much to worry about at this point in time. Thank you for that. That's a crystal view coming in. Back to the market. Like I said, markets been in cruise control mode, 500 points higher on the Nifty. So I think we've got Mitesh. We've got Mitesh back with us. Mitesh, it's a full green screen. So the gap up has happened. Now what? What should the trades be?
So there's no sign of worry as well. So I think I would still maintain that we will possibly go higher. We talked about 23,350, 400 as the target. We got a high of 23,368. And despite the fact that we have dropped about 50 odd points, the structure and the position on the intraday hourly to hourly chart still looks positive. So we can look at 23,600 and then 23,750 as the next target zones, maintain a long bias. And on the stock side, REC is something which is on the buy list. Keep a stop below levels of 407, 408 here, and look for target of 430 to begin with. And Reliance is also catching my attention. It's open with a gap up, and then while it's come off slightly of the day's high, but the gap is being sustained. Buy here with a stop at about 1225 for a target from 1280.
No, got that absolutely. So those are some individual. By the way, 10:1 still in terms of advances to decline at this point in time. A small name, Mitesh, have you looked at this one? Goldium, large volumes and big price move from the low of 250 back at about 350 in 3-4 days.
Yeah, it's, so Prashant, I used to track the stock earlier. It's, I think, into artificial lab-grown diamonds. And the stock had a weekly pivot at around 315, which was the closing in the November 24 month. And then we got a 307 weekly closing low on the 4th of April. While we didn't go below that, I think we immediately recovered, and then the weekly closings have been higher. I think bouncing back from weekly pivot, the intraday charts are good. The first target of 360 has been met. I think once we see a closing about the 365 zone, good chance that the stock will head towards 410 levels.
All right. Fair enough. Mitesh, we'll speak again. Thank you very much for joining us with that perspective. We take a quick break here. Commodities in focus. Manisha is here with us on the other side.
Welcome back. So equities are having a good morning. Let's figure out what's up with the commodity markets. We have Manisha Gupta with the latest. Over to you, Manisha.
Thank you so much for that. So, Rebel, yes, commodities also are having a good morning. Across board, we're looking at gains continuing here. The last week was a stronger one as well. So, I want to talk about the crude oil prices, which also is trading firm off those kind of 4-year lows that we saw in the previous week there. So, the US relaxing tariffs on key trade partners clearly seems to be supporting. The markets have seen 4% of gains for crude prices in last 1 week. It still is down 8% on month, though, but we have seen near-term gains come in for this one. Well, the another important point that the markets are reacting to is the China import numbers for the month of March, where the crude imports have been 5% on a higher side on year-on-year basis. Well, China clearly has been buying from Iran and Russia, as those reports show. The other thing that the markets are reacting to is the OPEC and allies statement, where there is an expectation that you could be looking at demand going slightly lower. Remember, OPEC also is adding more barrels into the market from the month of May to the tune of 411 million barrels per day. That is something that will keep the prices in check. The other thing that the street will watch out for is the US and Iran reconvening to meet this week yet again. Those conversations were left midway in the previous week. So that is something that you could be looking at some headlines coming in from. Saudi Arabia's numbers should be on your screens, because when you look at the production from that major oil producer, that stands at 8.9 million barrels per day for the first quarter of 2025, which is the lowest in last 14 years. So this is the kind of data from Saudi Arabia, from China, which seems to be supporting the crude oil prices right now. But what doesn't really support is the oil demand estimates for 2025. The weakest of them really coming in from Goldman Sachs. 0.3 million barrels of demand growth is what they're anticipating in this year as compared to last year. JP Morgan and UBS are talking about 0.8. Most bullish clearly is OPEC, which expects that there will be an additional demand of 1.3 million barrels per day in 2025. The other thing really is about the price outlook, where, as you can see, in the beginning of this year, most of these banks were talking about 80 and 85, and there was perhaps a 90 on those charts as well. But now we're looking at all of that below 80 and in some senses below 70 as well. Goldman Sachs report that came in yesterday talks about an average $63 a barrel of a price for Brent for this year now. You have 66 and 8 coming in from JP Morgan, UBS and Fitch. Stanchart is still slightly bullish on crude oil prices. They expect an average of Brent at 77 for this year. But as you can see, rest everybody else talking about below 70. That's an interesting chart on your screens now. And this is something that the Indian markets are now talking about. Last year, in the month of April, the average crude prices were at 89.4. We've seen a sharp decline from that, $20 down really, in April 2025 in sense of prices. There is a conversation, well, we've seen this custom duty movement as well. And most analysts, oil and gas analysts, will tell you that 2 rupees of a cut, if the prices continue to stay below 70, perhaps is a possibility now.
All right, Manisha, thank you very much for that. Absolutely. Oil, very, very sharp decline. Good for a big oil importer like India. Well, we'll take a quick commercial break here. On the other side, it's our special segment. It's the economy. Latha will connect with Shantanu Sengupta of Goldman Sachs, and they discuss the impact of this tariff zigzag back and forth on India and the global economy. Stay tuned.